Have you ever wondered how a bank can afford to give you a home loan worth millions of rupees, pay you interest on your savings, offer you a credit card, and still make billions in profit? After all, if banks are paying interest to depositors and lending money to customers, where does the profit actually come from? And here's the surprising part. Banks don't simply make money by keeping your money safe. Their real business is much more interesting. Banks take money from one group of people, lend it to another group, provide financial services, manage risk, process payments, and charge fees along the way. In this video, we are going to break down exactly how banks make money, using simple examples you can relate to. We'll look at interest income, the spread between deposits and loans, credit cards, fees, investments, foreign exchange, and even what happens when borrowers don't repay. By the end, you'll understand the basic business model behind one of the most important industries in the global economy. So, let's start with the simplest question. Where does a bank's money come from? 1. Banks make money from the interest spread. The most important source of income for traditional banks is something called the interest spread, or more broadly, the difference between what a bank earns on its assets and what it pays on its funding. Let's make this extremely simple. Imagine you deposit 100,000 into a savings or fixed deposit account. The bank doesn't usually just keep that 100,000 sitting untouched in a vault. Instead, the bank uses its funding base to support loans and other investments, subject to regulations, liquidity requirements, and its own risk management. Now imagine the bank lends money to another customer at a higher interest rate. For example, suppose the bank pays an average of 5% on certain deposits and funding, while it earns an average of 9% on loans. The difference is roughly 4 percentage points. On 1 crore of average loan assets, a 4% spread would represent about 4 lakh of annual interest margin before considering operating costs, credit losses, taxes, and other factors. This basic idea is at the heart of banking. The bank is essentially saying, we can obtain funds at one cost and deploy them at a higher return. That difference helps pay for employees, branches, technology, loan defaults, compliance, taxes, and ultimately shareholder profits. 2. But banks don't just use deposits. Here's where things get more interesting. You may hear people say, your bank takes your deposit and lends exactly that money to someone else. That's a useful beginner's explanation, but the real banking system is more complicated. Banks have multiple sources of funding and multiple uses for those funds. On the funding side, banks can have TIs, savings deposits, current accounts, fixed or term deposits, wholesale funding, bonds, and other borrowings, equity capital. On the asset side, banks can have home loans, personal loans, business loans, credit card balances, government securities, corporate bonds, other investments, cash and reserves. So a bank's balance sheet is constantly moving. Money comes in, money goes out, interest is earned, interest is paid, loans are repaid, new loans are created. And the bank manages all of this while making sure it has enough liquidity to meet withdrawals and payments. That's one reason banking is much more than simply taking deposits and giving loans. 3. Home loans are a major business. Let's take a common example, a home loan. Imagine you borrow 50 lakh from a bank to purchase a home. The bank charges you interest on that loan. If the interest rate is, for example, 8.5%, the bank earns interest from the loan over time. But the bank doesn't keep all of that interest as profit. It has costs. It has to pay for its funding. It has employees. It has technology and branches. It has regulatory and compliance costs. And most importantly, it has to account for the possibility that some borrowers won't repay. Still, home loans can be attractive to banks because they are typically long-term lending relationships and are secured by property. That doesn't make them risk-free. Property values can fall, borrowers can lose income, and economic conditions can change. But the security provides the bank with an additional layer of protection compared with some unsecured lending. 4. Personal loans can generate higher returns. Now compare a home loan with a personal loan. Personal loans are usually unsecured. That means the borrower doesn't normally provide a specific asset, such as a house, as collateral for the loan. Because the bank is taking more credit risk, personal loans can carry higher interest rates than many secured loans. For example, suppose a bank charges 14% on a particular category of personal loans, while its overall funding cost is significantly lower. The potential interest margin can be attractive, but there's a trade-off. Higher interest rates often come with higher credit risk. If borrowers stop paying, the bank may face losses. So banks don't simply ask, how much interest can we charge? They also ask, how likely is this customer to repay? That brings us to another important part of the banking business. 5. Credit cards are a powerful revenue source. Credit cards are one of the most interesting products in banking. Let's say you spend 50,000 using a credit card. If you pay the entire statement balance on time, you may avoid interest on those purchases, depending on the card's terms. But if you carry the balance forward, interest and other applicable charges can become significant. For banks, credit cards can generate revenue from multiple sources. These can include interest on revolving balances, annual or membership fees, late payment-related charges where applicable, cash advance charges, foreign exchange-related charges, merchant-related payment economics. There is another important source of revenue in card payments: interchange. When you use a card at a shop or online, the merchant generally doesn't receive the full transaction amount directly from the cardholder's bank. The payment ecosystem involves several participants, and part of the transaction economics can flow through the payment network to the issuing bank and other parties. So even when a customer pays their credit card bill in full and pays no interest, the bank may still earn revenue from the transaction. That's why banks and card companies are so interested in getting you to use their cards frequently. More transactions can mean more revenue opportunities. 6. Banks also make money from fees. Interest isn't the only way banks make money. Fees are another major source of revenue. Think about the financial products and services you use. A bank might charge fees for things such as OEIs, account-related services, certain ATM or cash services, loan processing, locker services, wealth management, investment products, remittances, foreign exchange, certain card services, business banking services, trade finance. Not every bank charges every fee, and many fees depend on the product, customer relationship, country, and applicable regulations. But collectively, these charges can become a significant revenue stream. Imagine a bank has millions of customers. Even a relatively small fee multiplied across a large customer base can produce substantial revenue. For example, a 100 fee sounds insignificant, but multiply 100 by 1 million transactions and you're looking at 10 crore in gross fees. That's the power of scale. 7. Banks make money from investments. Banks also invest money. A bank may hold government securities and other eligible financial assets as part of its liquidity management, regulatory requirements, and investment strategy. For example, suppose a bank buys a government bond. The bank may receive interest from that bond. It can also potentially make a gain or loss if the security is sold or its market value changes, depending on how the asset is classified and the applicable accounting rules. This means banks aren't only lenders. They're also major participants in financial markets. However, investment income is not guaranteed. Interest rates change. Bond prices can move. Markets can become volatile. So banks have to manage these risks carefully. Foreign exchange is another business. Have you ever exchanged Indian rupees for US dollars before traveling abroad? Or sent money internationally? Or received money from another country? Banks can make money from foreign exchange transactions. Suppose the market exchange rate suggests one price, but the bank offers customers a slightly different buying and selling rate. That difference can contribute to the bank's revenue. For example, imagine a bank buys a currency at one rate and sells it to customers at a slightly higher rate. The difference is part of the bank's trading or service economics, although the actual pricing and risk management are more complicated than this simple example. For large banks, handling huge volumes of international transactions, even small margins can become meaningful. 9. Banks make money from businesses. Most people think about banks in terms of personal banking, savings accounts, credit cards, home loans, personal loans, but business banking can be enormous. Companies need banks for A, working capital loans, business loans, cash management, payroll services, payment processing, trade, finance, letters of credit, foreign exchange, corporate deposits, treasury services. Imagine a large company that receives payments from thousands of customers every day. The bank can provide the infrastructure to collect, process, transfer, and manage that money. The bank may earn fees and interest income from these services. For large corporate customers, the relationship can be worth millions to the bank over many years. 10. Investment banking works differently. Now let's talk about a different type of banking. Investment banking. Investment banks can help companies raise money, issue shares or bonds, arrange mergers and acquisitions, and provide financial advice. Suppose a company wants to raise 1,000 crore through a bond issue. An investment bank may help structure the transaction, find investors, coordinate the process, and distribute the securities. For providing these services, the bank can earn fees. Similarly, if a company acquires another company for 5,000 crore, investment bankers may advise on valuation, financing, negotiations, and transaction structure. If the deal closes successfully, the bank can receive a substantial advisory fee. So investment banking can generate large revenues from individual transactions. 11. Wealth management is another revenue engine. Banks also make money by helping customers manage their wealth. Imagine you have 50 lakh to invest. Instead of managing everything yourself, you might use a bank's wealth management service. The bank could provide access to mutual funds, bonds, insurance products, investment portfolios, structured products, financial planning services. Depending on the product and arrangement, the bank may earn fees, commissions, or other forms of revenue. The important point is that banks are increasingly trying to become more than just places where people store money. They want to become part of your entire financial life. Your salary comes in, your bills go out, you use your credit card, you take a home loan, you invest, you buy insurance, you send money overseas, and ideally the bank earns something from several of these activities. 12. What happens when someone doesn't repay? Now we come to the darker side of banking. Loan defaults. Suppose a bank lends 10 lakh to a customer. The customer stops making payments. The bank doesn't simply lose 10 lakh immediately in every case. There can be recoveries, collateral, restructuring, collections, and other processes. But the bank still has to recognize expected or actual credit losses according to applicable accounting and regulatory rules. Banks therefore set aside money to absorb potential losses. These are often referred to as provisions or credit loss provisions. And this is extremely important. Imagine a bank earns 1,000 crore in interest and fees. That doesn't mean it made 1,000 crore in profit. If the bank experiences 300 crore in credit losses, it has to account for those losses. Then there are employee salaries, technology expenses, branch costs, marketing, taxes, regulatory costs, and many other expenses. What remains after all these costs is much closer to the bank's actual profit. 13. Why banks care so much about credit scores. This is also why your credit history matters. When a bank considers giving you a loan, it wants to estimate the probability that you'll repay. Banks may look at factors such as your credit history, existing debt, income, repayment behavior, loan amount, employment, or business information. The type of loan collateral, where applicable. A strong credit profile can signal lower risk. A weaker profile can signal higher risk. And from the bank's perspective, risk has a price. That's why two customers may sometimes receive different interest rates or different credit limits. The bank is trying to balance two things, earning a return and controlling the risk of losing money. 14. The bank's biggest advantage. Scale. Here's one of the most important secrets behind banking. Scale. A bank doesn't need to make a huge amount of money from every individual customer. It can make relatively small amounts across millions of customers and transactions. Imagine a bank has 10 million customers, millions of transactions every month, hundreds of thousands of loans, millions of card payments, thousands of business clients. Even modest revenue per customer can become enormous when multiplied across such a large network. This is one reason technology has become so important. The more efficiently a bank can process transactions and serve customers, the lower its cost per transaction can potentially become. 15. Why banks want your salary account. Have you ever wondered why banks aggressively market salary accounts? It's not just because they want to hold your salary. A salary account can become the starting point for a much larger relationship. Your salary comes in, then you may get a credit card, then a personal loan, then a home loan, then investments, then insurance, then international payments. The bank gets more opportunities to provide products and services. This is sometimes called cross-selling. From the bank's perspective, acquiring a new customer can be expensive. But once it has a relationship with that customer, offering additional relevant products can be more efficient. That's why your bank may constantly suggest new financial products. 16. So why banks sometimes offer free services? Here's another interesting question. If banks make money from customers, why do they offer free savings accounts, free mobile banking, free payment services, or other low-cost services? Because not every product needs to make money directly. A bank may offer a service at a very low cost to attract and retain customers. Once you are part of the bank's ecosystem, you may use other products that generate revenue. Think of it like a supermarket. A supermarket might discount one product to bring customers into the store. The customer doesn't buy only that discounted item. They buy several other things as well. Banks can use a similar strategy with financial services. 17. Banks also make money from payments. Every day, billions of digital payments happen around the world. When you make a payment using a card, bank transfer, or other payment method, multiple institutions and infrastructure providers can be involved. Depending on the payment method, banks may earn fees or transaction-related revenue. For example, businesses need payment gateways, merchant accounts, settlement services, collection systems, and cash management tools. Banks can provide many of these services. The individual transaction may generate only a small amount of revenue. But again, small margin X massive volume meal a big business. 18. What is net interest income? If you want to understand bank financial statements, one term you should know is net interest income or NII. In simple terms, net interest income is broadly the interest a bank earns on interest-generating assets minus the interest it pays on its interest-bearing liabilities. For example, as a bank earns 100 crores in interest, it pays 60 crore in interest to depositors and other funding sources. Its net interest income would be approximately 40 crore before considering other factors and accounting details. Analysts pay close attention to NII because it tells them a lot about the core economics of traditional banking. 19. What is net interest margin? Another important term is net interest margin or NIM. NIM measures the net interest income generated relative to the bank's interest-earning assets. In simple language, NIM tells us how effectively a bank is earning interest from its assets after accounting for the cost of interest-bearing funding. A higher NIM can be attractive because it suggests stronger interest margin economics. But a high NIM isn't automatically better. A bank might achieve a high margin by lending to riskier customers. If those customers default frequently, the bank's credit losses could wipe out the benefit. So investors look at profitability, risk, asset quality, capital strength, and many other factors together. 20. The banking business is a balancing act. At first glance, banking looks simple. Take deposits, give loans, earn the difference. But in reality, banking is a massive balancing act. Banks have to balance profitability with risk and liquidity and capital and regulation and customer trust. A bank can be profitable, but still fail if it doesn't have enough liquidity. A bank can have plenty of deposits but suffer huge losses if its loans perform badly. A bank can grow rapidly but become vulnerable if it takes too much risk. That's why banking is one of the most heavily regulated industries in the world. 21. Why trust is so important? There's another asset banks have that doesn't appear as a simple line item on a balance sheet. Trust. Imagine waking up tomorrow and believing your bank may not be able to return your money. What would happen? Customers might rush to withdraw their deposits. That could create a bank run. And because banks typically don't keep every deposited rupee in cash at all times, a sudden wave of withdrawals can create serious liquidity pressure. That's why confidence in the banking system matters enormously. Regulation, capital requirements, liquidity rules, deposit insurance systems in many countries, and central bank support mechanisms all exist in part to strengthen financial stability. The exact protections vary by country, but the basic lesson is universal. Banking depends on trust. 22. So, where does a bank's profit actually come from? Let's put everything together. A traditional bank can earn money through: first, interest income. It lends money and earns interest. Second, net interest margin. It manages the difference between what it earns on assets and what it pays for funding. Third, fees. It charges for selected financial services. Fourth, credit cards and payments. It can earn from interest, fees, and payment-related economics. Fifth, investments. It can earn interest and investment income from eligible securities and other assets. Sixth, foreign exchange. It can earn from currency transactions and related services. Seventh, business banking. It provides loans, payments, exchange, cash management, and trade finance services to companies. Eighth, wealth management. It earns fees and other revenue by helping customers manage investments. Ninth, investment banking. It can earn advisory, underwriting, and transaction fees. And finally, scale. Millions of customers and billions of transactions can turn relatively small margins into substantial revenue. 23. A simple example of a bank's business model. Let's imagine a fictional bank called Global Trust Bank. Suppose it has 1,000 crore of deposits and other funding. It uses its balance sheet to support loans and investments. Over a period, the bank earns 90 crore from interest on loans and investments. It pays 50 crores in interest to depositors and other funding providers. That leaves 40 crore in net interest income. Now imagine the bank earns another 15 crores from fees and payment services, 5 crore from investment and trading related income. That's 60 crore of revenue before certain expenses and credit costs. Then the bank has 20 crores of operating expenses, 10 crore of credit loss provisions. That leaves 30 crore before taxes and other applicable adjustments. This is a simplified example, not an actual bank's financial statement, but it shows something important. A bank's profit comes from managing a huge financial machine efficiently. 24. The biggest misconception about banks. One of the biggest misconceptions is banks make money by printing money. That's not how ordinary commercial banking works. Banks can create deposits when they extend loans, subject to the banking system's rules, capital constraints, liquidity, demand for credit, and other factors. But that doesn't mean banks can create unlimited wealth without consequences. Every loan creates an asset for the bank and a corresponding liability in the form of a deposit. The bank still faces credit risk. It still needs capital. It still needs liquidity. It still has to meet regulatory requirements. And the borrower still has to repay. So banking is not free money. It's a highly leveraged business built around credit, trust, risk management, and financial intermediation. 25. Why this matters to you. Understanding how banks make money can actually help you become a smarter customer. When a bank offers you a credit card, ask how does the bank make money from this product? When you're offered a loan, ask, what is the total cost? Not just the advertised interest rate. When you're offered as an investment product, ask what fees or commissions are involved. When a bank offers you a free service, ask what is the business model behind it? These questions don't mean banks are bad. Banks provide essential services and take on real risks. But understanding their incentives helps you make better financial decisions. Final takeaway. So how do banks make money? The short answer is banks make money by putting capital to work, charging for financial services, managing risk, and operating at enormous scale. Their biggest traditional source of income is the interest they earn from lending and investments, compared with the interest they pay on their funding. But that's only part of the story. Banks also earn money from credit cards, payment services, fees, foreign exchange, business banking, wealth management, investments, and investment banking. And after all of that, revenue comes the other side of the equation: operating costs, credit losses, taxes, capital requirements, technology, regulation, and risk. That's why a bank's revenue and profit are two very different things. The next time you see a bank branch, open a banking app, or receive a loan offer, remember, the bank isn't simply storing money. It's running one of the world's largest financial businesses, connecting savers, borrowers, businesses, investors, and payment systems. And now you know how it makes money. If you found this video useful, subscribe for more simple explanations of money, banking, credit, investing, and personal finance. And let me know in the comments. What should we explain next? How banks create money, how credit cards make money, or how banks calculate loan interest? Thanks for watching, and I'll see you in the next video. Disclaimer: this video is for educational and informational purposes only. It provides a simplified explanation of how banks generally generate revenue and should not be considered financial, investment, banking, tax, or legal advice. Banking products, regulations, fees, interest rates, accounting treatment, and consumer protections vary by country and institution. Always check the official terms and conditions of your bank or financial provider before making financial decisions.